we begin to have conversations around different assets that will allow you to get the multiple uses of a dollar or create the velocity of money. And one great place to utilize that is in cash value life insurance. So cash value life insurance, specifically the way we're speaking about it, Dennis, is through whole life insurance. And we want our clients to understand the utilization of whole life insurance. And we think that to simplify it, the easiest way to do that is by understanding, for starters, the different rates of return that exist within a life insurance policy. So like any traditional linear investment, a life insurance policy has an internal rate of return. And by definition, that's focusing on specifically the inner parts or features situated within the limits or surface of something. Okay. So the internal return is dollar for dollar what you're putting in versus what you'll be able to take out of that policy, typically recognized through the cash values of the policy. Now, most investments have one rate of return. You put money in a CD, it's an internal rate of return. You put money into the stock market, it's an internal rate of return. Your real estate could be an internal return. A life insurance policy also has something that's oftentimes not quantified. That's an eternal rate of return. And we call it eternal because it lasts forever. So there's certain benefits inside this policy that may or may not be living benefits, but they will last forever. And then properly structured, the internal return could also be utilized in a multiplier fashion through what we call the external return. And then as the external return is where the magic can happen if you know what you're doing. And it's how the money inside of the life insurance policy could be used outside. So external means derived from a source outside the subject affected. Okay. So once we create, cash flow begins to go into the whole life insurance policy. Whole life insurance contracts, I should start by saying, are primarily purchased for the reason of death benefit. Okay. The main reason you always buy a life insurance policy is death benefit. Now, the internal and the external benefits of that policy are ancillary benefits to what we feel is the biggest benefit of a life insurance policy, which is the death benefit. Now, as we're making deposits into this permanent policy, we're also starting to develop a cash value. That cash value has two elements to it. It has a guaranteed component, which is a contractual guarantee backed by the full faith of the insurance carrier, plus a non-guaranteed benefit, which is comprised of the dividends that we receive from the insurance company. Dividends are not guaranteed. They're determined annually by the board of directors of the insurance companies. And then as the good insurance companies have paid dividends on their cash value policies for over 100 years. So again, we start to get cash flow into the policy. As the cash flow starts to accumulate over a long period of time, we start to earn dividends on that cash value, which gives us a return on the money that we're depositing into the plan. The next rate of return is the eternal return. And as we mentioned, forever, there'll be a death benefit in place. A lot of the folks that we work with are clients that have accumulated a lot of wealth, either through their business, their real estate assets, or however they might have accumulated it. And that death benefit becomes a tremendous asset, whether it's for estate planning purposes or for purposes of replacing their income should they die prematurely. But that becomes an asset on their balance sheet that they'll own, and the goal is owning that asset forever. One thing business owners love, which a lot of real estate entrepreneurs are, is that the cash value inside of that policy, depending on your state, could have lawsuit or creditor protection, which adds another layer of asset protection, which always seems to be something that's very important to folks who are building assets and creating wealth. Depending on your age and health, there could be disability benefits, which could waive your premiums if in the event that you were ill or sick or long-term disabled and no longer able to fund your policy. And then lastly, one of the additional benefits, I should say, is a long-term care benefit, which a lot of policies now, Dennis, a lot of companies have gotten out of the long-term care business. And we've identified that the most efficient way to utilize that is by having a life insurance policy also have a rider that could provide some long-term care benefits. So these are really important benefits, aside from the cash value, that are very important to understand, that are available through riders through a life insurance policy. And then These life insurance policies, although they're designed through your working years to accumulate cash and maybe help with college or some other thing that might be important to you, they could be used for income streams in the future. One of the biggest risks many folks face in retirement is the risk of outliving money. And when you have a boatload of cash value inside of your policy in retirement years, you could use that money through dividends, through loans, or through annuitizing the policy as a creative structure to create retirement income. Now, as many advantages as we discussed, those are really only two of the main advantages of a life insurance policy. One of the huge benefits of a life insurance policy is there's an additional benefit that we refer to as an external rate of return inside the insurance policy. So let me clarify what that means. Externally, we can use the money that's inside of the cash value as it accumulates and do something different with it. However, it's not going to affect the internal return of the policy, and it may not affect the eternal benefits of the policy, notwithstanding the death benefit. Meaning if you borrowed money against your policy and there was a loan on it and you passed away, your beneficiaries would receive your death benefit minus the loaned amount on the policy.